Good day, students. This is Professor Alexander Buchholz coming to you with Chapter 11, Worldwide Accounting Diversity and International Accounting Standards. So again, several objectives with this particular chapter, which we wish to cover in the context of the lecture. Describe how the changing world environment is leading to an increased focus on international financial reporting standards, hereinafter referred to as IFRS. Explain some of the remaining differences between IFRS and US GAAP. List some of the milestones that must be achieved before the SEC will require adoption of IFRS. Describe the SEC, again, Securities and Exchange Commission's work plan for incorporating IFRS into the financial reporting system for US issuers. Describe the four remaining joint convergent topics between the IFRS and FASB. List the steps that a non-US company must follow to list its shares on a US stock market. Explain the role of Form 20F filed with the Securities and Exchange Commission. The last one of the American Depository Receipts is really beyond the focus of our course, and as such we will not be covering it. So let's talk about the road convergence. Accountability and the funding of the International Accounting Standards Corporation Foundation. The IASB is the International Accounting Standards Board, and that's established to develop global standards for financial reporting. The oversight is by the IASC Foundation, which is a standalone, not-for-profit organization. It's responsible for the activities of the IASB and is governed by 22 trustees whose backgrounds are geographically diverse. Initially, the IASB operations were financed through voluntary contributions by approximately 200 organizations. A majority of the finances are now based on national financing regimes, proportionate to a country's relative gross national product. Further progress on financing is essential to safeguard the IFRS Foundation's position as the world's independent accounting standard setter. In September of 2002, FASB and the IASB issued a Norwalk Agreement, including a Memorandum of Understanding. This was done so that we would begin the road to convergence. And through 2005-2009, FASB and IASB wanted the commitment to converge GAAP and IFRS. As we go throughout the different standards, eventually leading to 2011, the SEC released a staff paper discussing possible work plans. Subsequent to that, though, with different elections and everything else, and the economy crashing a little in 11, IFRS was put as a back burner. And basically, we have yet to truly converge. And nobody has really talked about convergence at any time soon. The basis for the consideration of the use of IFRS by the U.S. includes the following milestones: improvements in accounting standards, accountability and funding of the IASC Foundation, improvement in the ability to use interactive data for IFRS reporting, education and training relating to IFRS. And these four milestones relate to issues that need to be addressed before we can really adopt. The work plan for incorporating IFRS has been as follows: a full adoption of IFRS without any endorsement mechanism. Full adoption of IFRS following a staged transition over several years. An option for U.S. issuers to apply IFRS. Retaining U.S. GAAP with continued convergence efforts, with or without a specific mechanism in place to promote alignment with IFRS. And retaining a U.S. standard setter, known as condorsement. That seems to be the newer trend. And what this means is when IFRS passes a new regulation, we kind of do something similar. So again, not being done identically, but kind of a condorsement. In 2009, the SEC issued the rule Interactive Data to improve financial reporting. This requires domestic and foreign companies using U.S. GAAP and eventually those using IFRS to provide their business statements in XBRL, Extensible Business Reporting Language. This format, which we're talking about now, provides an exhibit to the current reports and registration statements and provides detailed tagging of the footnotes and schedules. In 2011, the SEC acknowledged that it would be possible for foreign private issuers using IFRS and filing with the SEC to file an XBRL because the SEC had not approved the IFRS XBRL taxonomy. So, since March of 2011, the SEC has yet to approve the IFRS taxonomy that will allow IFRS to file XBRL. So again, some possible adoption approaches. Full adoption. Adopt IFRS after some incorporation process. The condorsement, which is what we're seeing a lot of here in the U.S., meaning the U.S. GAAP would be retained, but the FASB would incorporate IFRS into U.S. GAAP over a defined period. The FASB would incorporate newly issued IFRS into U.S. GAAP pursuant to some established endorsement protocol. Overall, IFRS is principles-based. This is very different than what we have here in the United States, where we are rules-based. And a lot of people have difficulty with that. They don't like to see that we are using this concept of principles. They like rules. So a lot of people do have difficulty with this. The role of the SEC and FASB. The SEC would retain the ultimate authority to establish financial reporting requirements in instances in which interpretative guidance is required or appropriate for U.S. constituents. The SEC could issue guidance following similar processes to those employed currently, such as issuing staff accounting bulletins. The staff would monitor international standard-setting developments. Currently, IFRS does not have any requirements for oil and gas companies, so the SEC could decide to retain reporting requirements upon incorporation of IFRS. Some similarities and differences that we want to be aware of as students of accounting. Again, U.S. GAAP, more rules-based. IFRS, more principles-based. The U.S. GAAP hierarchy, which is effective since September of 2009, is authoritative. It's included in the FASB Accounting Standards Codification. If it is not included here, it is non-authoritative. An example is your textbook. Your textbook is non-authoritative. You can never win an argument with somebody merely by showing them your accounting textbook. The IFRS hierarchy basically states as follows. apply a method that is relevant, reliable, represents faithfully the financial position, the performance, and cash flows of the firm, reflect the economic substance of the firm. Look to recent pronouncements of other standard setters which use a similar conceptual framework. And finally, the conceptual framework. What we want to now understand, and we'll see as our textbook as well, is some similarities and differences. So a comparison of financial statement presentation under US GAAP and IFRS select items. Generally, in the United States, comparative financial statements are presented. Public companies are required to present 2 years for the balance sheet and 3 years for all other statements. IFRS, comparative information, must be presented for all amounts reported in the financials. The balance sheet presentation for US GAAP, entities may present either classified or non-classified. Items on the balance sheet are listed in order of decreasing liquidity. Public companies must follow Reg S.X. IFRS does not prescribe a format, but generally requires current, non-current format be used and listed in order of increasing liquidity, unless a liquidity format is more relevant and reliable. The income statement presentation is usually presented as a single step or multiple step. Expenditures listed by function. IFRS does not prescribe a format, but expenditures are listed either by function or nature. Now, extraordinary items. Please note, there has been a change in US GAAP. We are no longer using extraordinary items. It used to be unusual and infrequent, and this has been changed actually this go-around for 12/31/17 that extraordinary items are no longer permitted. IFRS already had that. Unusual items. Individually significant items are reported on the face of the income statement and disclosed. IFRS, separate disclosure required, but may be reported on the income statement. Deferred taxes classified. Deferred taxes have now been shifted to be presented as non-current. So again, has been a change to this slide. Deferred taxes are presented as non-current based on the nature. Deferred taxes are presented as non-current is already being done in the IFRS approach. The statement of cash flows. Standard headings, but more guidance on items in each category. Direct or indirect formats are allowed. IFRS, standard headings, but limited guidance. So for example, cash that we pay for interest under IFRS can be either operating or financing. Inventory. In US GAAP, the biggest inventory item is LIFO permitted. Now, another change has come about here. In our earlier accounting days, we knew this as the lower of cost or market. Ladies and gentlemen, please note this has now changed. We actually follow IFRS, the lower of cost or net realizable value. This is again newer change. In IFRS, ladies and gentlemen, LIFO is prohibited. That's one of the biggest inventory changes that we have. Reversal of inventory write-downs. So again, write-downs always go down, and reversals of previously written down amounts are prohibited. You're not allowed to reverse it. In IFRS, previously written down amounts can be reversed up to the original impairment loss. Development costs. In GAAP, research and development costs are expensed as incurred. Under IFRS, Development costs are capitalized when technical and economic feasibility can be demonstrated with specific criteria. That's different than US GAAP. So development costs are capitalized, means shown on the balance sheet. Property, plant, and equipment. Historical cost is used, and revaluations are not allowed. However, under IFRS, historical costs or revalued amounts are used, and regular revaluation of assets is required once chosen. Review for impairment of long-lived assets. Under US GAAP, performed whenever events or changes in circumstances indicate that the carrying amount of the asset may not be recoverable. IFRS is only performed at the reporting date. The method for determining long-lived asset impairments. Well, a two-step approach is used in the US GAAP. If the recoverability test is not met, then the impairment test is performed, meaning that the amount the carrying value exceeds the fair value. In IFRS, a one-step approach is used, measured as the amount by which the carrying value exceeds the recoverable amount. The recoverable amount is the higher of the fair value less cost to sell, or the present value of future cash flows less cost to dispose. Let's actually take a look at an example with this. It would be appropriate. Looking, for example, in our actual textbook here, problem 30. Hirsch Company acquired equipment at the beginning of 2017 at a cost of $135,000. The equipment has a 5-year life with no expected salvage value and is depreciated on a straight-line basis. At December 31st, 2017, Hirsch compiled the following information related to this equipment. Expected future cash flows from the use of equipment, $116,000. Present value of expected future cash flows, $100,000. Fair value, selling price, less cost to dispose. Assume that a US-based company is issuing securities to foreign investors who require financial statements be prepared in accordance with IFRS. Thus, adjustments from US GAAP to IFRS must be made. Prepare the journal entries for this equipment for the years ended December 31st, 2017 and 18 under US GAAP and IFRS. And B, prepare the entries that Hirsch would make on December 31st, 2017 and 18 conversion worksheets to convert US GAAP to IFRS. So let's prepare some journal entries. We debit equipment and credit cash for $135,000. Again, we bought this is $135,000. The depreciation expense, because this is straight line, is $27,000. $135,000, no salvage, 5 years, $27,000. Now the question would be, is as of 12/31/2017, the impairment loss. So, under US GAAP, this is how we would determine if there's impairment. We would want to look at the expected future cash flows, again, not present value, the expected cash flows, to see that it exceeds the carrying value. Well, the carrying value right now, we take cost less depreciation, the carrying amount is 108. Since the expected future cash flows exceed the carrying, there is no impairment, no adjustments to be made, no adjustments to be made. However, when we then get to our IFRS requirement, we now have a little bit of a problem. In accordance with IFRS, they do it differently. The asset is impaired when the carrying amount, still 108, exceeds the recoverable amount. The recoverable amount is going to be the present value of the cash flows and the fair value with selling price less cost to complete, whichever is greater. That would mean, based on these two numbers, the greater would be 100,000. Well, if the carrying is 108 and the recoverable is 100, we would now have an impairment loss of $8,000, which is our debit of 8, credit. Well, now, at this stage of the game, we would also have to be very cautious, because in 2018, depreciation would be $27,000 under US GAAP. But hold on. Under IFRS, you've now changed the life of the asset to 100,000. 100 divided by 4 remaining years is 4 years, which is why you'll notice over here we now have 25,000. Okay, so again, that's just a high level of what we wanted to show you with that. Going back to our slides, when we look here at the provision for liabilities, well, the provision for liabilities, as we know, is we record a contingent liability if it is probable and can be reasonably estimated. In IFRS, they take the present obligation that is recorded if probable, more likely than not, and can be reasonably estimated. Contingent liability, if probable and can be estimated, the liability is recognized in the financial. Otherwise, we have a footnote. A possible obligation that will be confirmed by a certain future event, not recognized in the financial, disclosed is not, if not remote. Reduced disclosure of contingent liabilities. In that case, no reduced disclosure permitted. Reduced disclosure permitted if it would severely prejudice the entity's position with another party to the obligation. When we have a range of outcomes for a liability, in GAAP, the most likely outcome should be accrued. When the outcome is more likely, accrue the minimum. In IFRS, the best estimate of obligation should be used. If all outcomes are likely, use the midpoint. Stock dividends declared after the balance sheet date. The SEC requires that the financial statements be adjusted for stock dividends declared after the balance sheet date. Under IFRS, they are not adjusted. Related party, similar to IFRS, in that the nature of the relationship, amount of transactions, outstanding balances, terms and types of the transactions are disclosed. Compensation of key employees are not required to be disclosed within the financial statements, normally of a typical company. We talked about SEC, however, those filings are a little different. For IFRS, they're required regardless. Capitalization of interest. requires interest to be capitalized when it's part of an asset being constructed. Interest is capitalized as part of the cost of a qualifying asset. Depreciation. Component depreciation is allowed but seldom used. Under IFRS, it's required. Earnings per share. Again, both are presented on the face of the income statement. Accompanied financial information. A financial and operational review are not required. SEC registrants must include, however, a management discussion and analysis section. In IFRS, a financial and operational review is encouraged but not required. Changes in estimates handled prospectively under both IFRS and US GAAP. Changes in methods. Accounting policy changes are accounted for retrospectively by adjusting opening equity and comparatives. Under IFRS, again, same type of approach. Error corrections under US GAAP. Error corrections are accounted for retrospectively by adjusting opening balances, very similar to IFRS. Long-term liabilities expected to be refinanced. Classification may consider events after the reporting date based on ability and intent. IFRS limits it to the reporting date. So if we're going to refinance our mortgage at 12/31/17 and there's an intent, we can show it as a long-term liability under GAAP. If, however, 12/31 we've not filled out any paperwork, IFRS says show it as a current liability that's expected to be repaid. An example of the IFRS statements issued. 2-year comparative. Look at the order though. Non-current before current. You also notice that the equity seems to be ahead of the liabilities. Different format. The consolidated income statement from IFRS. So again, revenue, expenses, and our consolidated cash flow. Operating, but again, investing, financing. Look at the investing activities. Look at the financing. Interest paid. Now, we don't see that usually. So again, the Convergence Project. As of the beginning of 2014, 4 major convergence projects remained. Now, leases we've kind of come together on. Revenue recognition begins really as of 12/30 for entities beginning this particular year, 12/31/17. So many are implementing this now for the publicly traded, next year for non-publicly traded, insurance contracts, and financial instruments. So again, for lease accounting convergence, we've kind of gotten there. In the US, there's operating and capital. International, they're called financing leases. Right now, these are how the accounting treatments are. So what happens a little bit differently in the US GAAP versus IFRS is they have a little more discretion. So let's look at the criteria. Transfers title by the end of the lease. Same in both. Lease contains a BPO, bargain purchase option. The third, lease term is greater than 75%. Lease term is for a major part. What does a major part mean? Present value of the minimum lease payments is greater than or equal to 90% of the fair value of the leased asset. Present value of the minimum lease payment is equal to substantially. Again, what does substantially mean? And the leased asset is a specialized asset that only the USC can use. Different spin on IFRS accounting versus ours. Now, in the least convergence project, the boards have not agreed on all accounting, but similar in both accounting rules, US GAAP and IFRS will no longer recognize operating leases as expenses. Everything will go as a liability on the balance sheet and an asset. That's a big game changer here in the US. As far as revenue recognition is concerned, they've moved forward with this. And now what we have is that the boards have agreed upon a rev rec model. The model would apply to contracts with customers where a contract is an obligation between two or more parties that creates an obligation. And it does not need to be in writing. There are 5 steps in this proposed model. Identify the contract with the customer. Identify the separate performance obligation. Determine the transaction price. And allocate the transaction price to the separate performance obligation. And recognize revenue. So consider customer consideration model. Revenue is recognized from increases in the net contract position. So revenue is recognized where there is an increase in the contract asset or a decrease in the contract liability from satisfying performance obligations. That's the core of the rev rec model. Now, revenue recognition, believe it or not, that we've adopted, this has been adopted by us in the United States, is principles based. So we've actually given up our rules for these principles. Again, we're still working on the insurance contracts at this point in time, and IASB has no current standards. Financial instruments, another project, classification and measurement, and impairment. Neither project is likely to result in a total converged standard because the IASB and the FASB are considering 2 different models. Some issues that we have is that LIFO, as we said, not acceptable under international standards. IASB recommends specific cost. If not, the benchmark is FIFO or weighted average. LIFO conformity rule established in 1939 requires that taxpayers that use LIFO must also use it for financial reporting purposes. So, if we were to adopt this approach, those that are filed with the SEC are the potential costs of switching from LIFO to another method. Private, small, and medium-sized companies. So again, similar to the United States, the IASB did release IFRS for small and medium-sized entities. It was only in 2012 in the United States that the Financial Accounting Foundation established the PCC, the Private Company Council, kind of having what was called a framework for the smaller and the mid-sized private companies as opposed to these large publicly traded companies where the accounting may not have been as fair and appropriate for both. In December of 2013, the board and the Private Company Council issued Private Company Decision-Making Framework, a guide for evaluating financial accounting and reporting. SEC registration and U.S. listing for non-U.S. companies. Registration with the SEC under the 34 Securities Act is mandatory for non-U.S. companies that intend to list on a U.S. stock market. Foreign companies are required to comply with the SEC continuous reporting requirements. U.S. companies file Forms 10K and 10Q. Foreign companies file Forms 20F annual and 6K interim. The 20F statement is similar to the 10K, but the 20F allows the non-U.S. company to use IFRS as promulgated by the IASB or to retain its local GAAP reporting, so long as it meets one of two alternative conditions. The firm may either reconcile net income and the shareholders' equity, thus showing earnings based on U.S. GAAP, or fully disclose all financial information required of U.S. firms. Statement F1. First-time offer of securities by any non-U.S. company that comes under the definition of a foreign private issuer requires filing an F1 statement as the principal registration. The prospectus contains financial statements presented in accordance with U.S. GAAP or IFRS, or include an audited reconciliation of the home country GAAP to U.S. GAAP. And that concludes our chapter on worldwide accounting diversity. Please listen to the chapter again before completing any and all assignments associated. Thank you, and we'll see you online real soon.